Welcome back. This month we're talking to Chad Slater from Morphic Asset Management about how the Morphic Fund went in June 2015. Welcome, Chad.
Thanks.
Firstly, how did June go?
Oh, look, June was a very tough month. Global markets were down about 3%, and we managed to be only down about 2.5%, which not a bad outcome in a quite tough month.
And obviously Greece is front and centre of everyone's minds at the current time. How are you positioned for Greece?
Look, the situation is quite fluid at the moment, to be honest. So by the time the viewers actually watch this, the facts on the ground may have even changed then. Over the last couple of weeks, there's been quite a few changes, particularly with the call for the referendum. In particular, the referendum, I think, came at over the weekend when people were not positioned for this. So in the lead up to last weekend, a lot of people had actually taken their hedges off, us included, as we thought a resolution was about to come about. So as such, Monday morning was quite a frenetic morning, but since then we've repositioned with some number of hedges in place to protect on the downside.
And have you changed your view and position and how you're going to handle it?
Look, no, our view actually hasn't changed all that much. Our view still remains that there will be a resolution here. But quite importantly, we think no matter, even if the outcome of the vote on the weekend is that they decide to leave, essentially, we think the risks are going to be contained, and the contagion risks are a lot lower than what they were 2 or 3 years ago now. For example, the ECB has introduced QE recently this year. This is enabling them to buy bonds on the periphery debt. So what we think ultimately is that this will be contained within Greece, and the rest of Europe will actually not be infected by this.
Chad, the other big news at the moment is China. There's been some sharp corrections there over the last week or two. What's your view on China?
Look, as your viewers are probably aware that Morphic has been positioned long China, and we have a view that with all the economic reforms taking place that this is still a good place to invest. But clearly the last month or so, which has seen markets there fall between 10 and 15%, has made us question some of our views, but we still remain committed to the idea that economic reform will flow through to better investment returns there. Now, there is a lot of talk out there about there being a bubble in China, and some of the stocks, particularly on the Shenzhen and the Shanghai markets, are what we would say frothy valuations. But we would point out that a lot of the shares that we own are actually listed in Hong Kong, and these stocks trade at what we would say undemanding multiples. So, for example, Ping An trades at like 12.5 times earnings now. Some of the toll roads we own trade at 13 or 14 times. And to give some context to this, Australian stock market trades at about 15.5 times. So we don't think these stocks are bubble valuations.
So how do you think China will end up?
So yeah, our view is this is not the end, that this correction is actually a correction inside a larger bull market. Generally, as a rule of thumb, markets finish when there's a tighter monetary policy, and what we saw over the weekend, just gone, was that the Chinese market has reacted positively to the cuts that were introduced by the central bank over there. And longer term, with the cheaper interest rates, etc., that this market will continue to rally. It ends when the interest rates go up. Now, the analogy I might use for your viewers is that think of the Nasdaq between 1994 and 2000. 1998 saw the Nasdaq drop 25%. It then went on to rally another 100%. It only ended in 2000 with the actual raising of interest rates by the Federal Reserve.
And what else is interesting the minds at Morphic in the rest of the world at the moment?
Yeah, elsewhere in the world there are some interesting things, particularly in the US. The US is actually the forgotten area of the world in the last month or two, as focus has been on China and on Greece. Now, the US there is continuing to have very good jobs data, and last month in particular was excellent. And what we're seeing here is the Fed Reserve is moving closer and closer to actually having to make up its mind whether it's going to raise rates in September or in December, or not at all. Now, if they're going to go in September, they're going to need to start communicating this to the market very shortly. They will not want to surprise the market at this point. So what you're seeing over the weekend, this is really quite interesting, is Dudley, one of the more senior members there, along with Yellen, he came out and had a speech on Sunday night. So by Sunday night, he would have been aware of what was happening in Greece. And he chose to largely, and I'll paraphrase this, say, we will continue on doing what we want to do, which is looking at raising rates in September. He said it's a live meeting. So we think when markets actually return to focusing on the US data and return, at some point Greece will settle down, that I think they will be a little bit surprised to see that the Fed is on track to raise rates later this year.
And do you see any great danger in that?
Our view is this is unlikely to be a great danger in the short term. This is probably the most telegraphed rate increase we've seen in the history of the Federal Reserve. We've been talking about rates going up in the US now for almost 3 years. They've ummed and ahed for the better part of 18 months about whether to increase. So anyone who's unprepared for rates going up in the short term, I would say, probably hasn't been on top of their data. Ultimately though, higher rates, as I said, with China, do lead to slower economies. So we think the risk is more 2016 risk rather than the first rate increase risk.
So is it fair to say, Chad, just listening to all that, that there's plenty of risk out there, but you're quite comfortable with what those risks are and you're well positioned for it?
Look, Chris, I think there is risk out there, particularly this time of year, and we know seasonally as well that markets tend to struggle through to September, October. However, for all the points I've outlined, we think 2016 is more likely to be a year of heavier risks than 2015. We do think that these problems, particularly in Greece, will get resolved in the next couple of months. We do think markets will return to focusing on what is actually a good GDP story globally. European growth has recovered. US growth is actually going to have a better second half than first half. So we think if there are these bigger risks, these risks are 2016 risks.
Chad, thank you very much. We look forward to speaking to yourself again next month.
Thank you.